Hello, I'm Jim Adams. I've been selling options for over 15 months now. I've done over 250 trades and I've been very successful with it. So today I want to share with you the things that have made the difference for me. My success rate has been over 95%, and it's just a few things that have made the difference. So stay tuned. I think you're going to really enjoy what I have for you today. Welcome to the Easy Investing Income YouTube channel. This is a channel where I share with others how to sell options using safe option strategies, strategies such as the options wheel strategy. I've been on a journey for 15 months and I've learned over those 15 months how to do it the right way. Today I'm going to share with you what I think the key tips are for selling options and making money and doing it in such a way that you don't take huge risks. So, that being said, let's go ahead and get started. First of all, it's really important to select quality investments. To me, a quality investment is that it has good financials, it makes money, it's got good PE ratio, it pays dividends, not just, it doesn't just pay dividends, but it grows its dividend year over year. Part of the reason for that is I'm a dividend investor and I want to own these shares. So if I get assigned, I'm okay on either end, meaning if the put gets assigned and I own those shares, it's something I want to own at the price that I'm willing to own it. If they get assigned with a call and it gets called away, well, it gets called away at a price I'm okay with. So I don't really go into really high volatile stocks, and I don't go into stocks that pay, you know, don't have any income. Uh, Even very expensive stocks I stay away from, such stocks as Tesla. With it being over $1,000, it's just too pricey for me. And that brings me to my next big point: is I stick to less expensive stocks. I try to keep it under 150 or maybe even under 125. I've been burned with Microsoft. It went up and up and up and went well over $300, and so I stay away from those real expensive stocks. My only exception is Apple, but again, I try to get it, or I'm trying to get it or own it, and I try to do that under $125 per share. I believe it's over 160 now. It may have come down a little bit today, but it's kind of the exception to the rule. I used to trade Microsoft, but I'm holding off until Microsoft comes way down. Right now, it's just too expensive. Um, and again, I primarily deal with securities I want to own. So anything I put in my watch list or securities I want to own, not really highly volatile stocks. To give you a for instance, if you go and you try to sell puts on something that's really volatile, say it's in the $300 range, and the market does a major correction or bad earnings. Several companies recently have had fairly bad earnings, things like IBM, Cisco, Intel, which are three stocks that I do like. In the short term, they've dropped over 10%. I think IBM dropped 10%, or all of them dropped 10%. Now, being that they're not real expensive, IBM may be the most expensive. I think it's around 130 or 120. So a 10% drop for it is the biggest hit. It's like $12 now. With Intel, I think it trades between 50, 45 and 60 or something along those lines. So a 10% drop for it is like $4.50, $5. So again, not a huge hit. And same thing with Cisco. I think it also trades in a similar range. So you don't take a huge hit. Now at the higher stocks, say you're trading something in the $300 range. Again, I'll use Microsoft, and they come out with bad earnings. Now, if it drops 10%, you're talking $30, $40, and you could be underwater by a significant amount. And that's something I prefer not to do. So I'm always looking for securities that are affordable, not really expensive. Now, that brings me to my next point, which is I strictly do safe option strategies. I don't. I do covered calls where I already own the stock, so I will sell a call on it. And I also do cash secured put. I typically have enough money to cover any of the trades that I have, with the exception being I will buy an arm, like if I find a cash secured put and I can buy an outer arm to make it a vertical credit spread, then I will do that. Say it's 10, 15, $20 to really reduce the risk with that trade, and also reduce the amount of margin that's required. Margin meaning, say it's a $40 stock and I sell a cash secured put. Well, I need $4,000 to cover those 100 shares. Now, if I'm able to buy an outer arm, so say I can buy a $35 outer arm for that $40 put, then all I need is $500, but I still keep enough cash in my account to cover that. Again, so it's still kind of like a cash secured put, even though it's a vertical credit spread. Hopefully that's not too confusing, but that's just something I prefer to do, something I like to do to minimize my risk. So, and then I also look at a 20 delta. Now in my retirement accounts, I've done a bit more than 20 delta. And for me, a 20 delta is like an 80% probability that it's going to expire outside the money. So in my retirement accounts, I've gone a little bit higher. Primarily because most of my trades have not been assigned. I think of the nearly 250 trades that I did, I only have had 4 assignments, which is a real small amount. So I feel like I may be missing some premium, so I'm going to up the risk a bit, but I may go from 20 to 30 or between that range, between 20 and 30. I rarely will go above 30 unless it's rolling to get out of trouble. That's the only exception. I may take a little bit more risk, but I'll talk about that next towards the end of this video. I also like to think of it as 10% above or below. So if it's a call, if I sell a call, I want to at least earn 10% on that position from that point in time. Now, if the stock has come way down, I don't want to earn 10% just to get back to where I was before. I want to earn 10%, near its 52-week high. And then for a put, I'd also like to get a 10%. So if it's something like Intel and it's selling for 50, I'd like to get it for 45. So I kind of add that with the delta to come up with trades that are fairly safe. And again, these are on companies that I want to own, so I always want to get them at a good price. I also look at dividends. So if I can get something, I'll use that same example with Intel. If I can get it at 30, 35 or 40, well, let's say it's 50. If I can get it at 45, then the dividend is that much better, meaning it may be a 4% dividend versus a 3.7 or 3.5. I think Intel's paying like a 3.25 dividend. So I like to get between 3 and 4% dividends on any of the securities that I own. I do have some exceptions that are 2, maybe 2.5, but overall I'm shooting for 4% with my dividends. And then the other big deal is I don't ever wait to expiration to manage my trade. I always look 2 weeks out, and my patrons will probably already know that because I share my work spreadsheets or my planning spreadsheets every Monday, and I typically look 2 weeks out. So if something's expiring next week, I will be looking to manage it this week. I don't wait the week of, mainly because that's when I've gotten burned. And I also keep track of ex-dividend dates. An ex-dividend date has caught me several times where someone will, have the shares assigned to them because they want to earn that dividend too. So they have to stay aware of the dividend date. So again, in my planning worksheets, I note down any dividend dates that may impact the trades that are coming up. And then I typically will either close them, roll them, expire, or let them be assigned. So if it's deep in the money, then we'll look, can I close it without a big loss? And if that's the case, well, then I might close it. But if I can roll it and still earn some premium and keep the strike price at least where it currently is, maybe a little bit better, then I will roll it, because I found if I can buy some more time, especially if it's an earning announcement that may change down the road and it's a quality stock, then it's well worth it to actually roll it and try to lower the strike price and may gain more premium. And I found probably 95% of the time I'm able to do that. I'm able to roll them. But there again, don't wait to the last minute. You're going to end up putting yourself in trouble. And then with one thing I have changed is I check in my account. I have in Schwab, I can actually look at the options, and I can look at anything that's 90%, and I have it sorted. So I see if there's any trades that are 90% profitable, and I'll close those automatically. And that has worked out really well. I've only been doing that the last 2 months, but I'm finding that I'm closing quite a bit of trades or contracts, and it's given me the opportunity to make a little bit more money than I was before, mainly because a lot of times you'd end up rolling them and you'd pay more to roll them. Of course, rolling, let me just define that. It's really just closing your position and opening another position, and those two trades together are rolling. So if you can make more premium than what you're spending to close the trade, then it's well worth it to do it. But if I can close the trade at a point when the contract is really, really inexpensive, or the profitability is really high, then I can do better by buying it at a later date versus having to roll it. Hopefully that makes sense. I've done a couple of examples in other videos, so I encourage you to take a look at other videos that may relate to that. So those are the main things that I do differently, and it's really made a big difference for me. But again, if you don't pick quality companies and you're really just in it for earning a quick buck quickly, then this isn't the strategy for you. It's kind of slow go. It takes time, to earn good returns. In my brokerage, I've earned like 6% a year, which is a 0.5% a month. Now in my retirement accounts, I've done better. I've done this past month, or this month in November, I've done closer to 1.5% per month, which is 18% per year. But I am taking a little bit more risk, and a couple of those trades are currently in the money, so I don't know what's going to happen with them. I'm still hoping I can roll them and get out of trouble with that. But to me, it's worth it if I can earn that much more in my retirement accounts. And since I don't have tax issues with it, and I don't have to worry about the profits, it's a little bit easier to trade in those accounts. So as always, thank you for joining me. Please hit that like button, subscribe if you want to learn more. I have a Patreon page where I share what I'm trading. I do it every day. If I do a trade, I actually put it out on Patreon for any of my patrons, so that they can also do that trade if they want to do it. I also put all my spreadsheets out there, my planning spreadsheets, my monthly return spreadsheets, including both my retirement and my regular brokerage. So I encourage you to take a look at that. It may be something you might find interesting. I've gotten good feedback from my current patrons. And as always, I wish you the best with your trading, and thanks for joining me today. Thank you. Bye-bye.